Hello, and welcome to the AM Best and Demex webinar looking at the capital treatment of property catastrophe reinsurance products. My name is Nick Hill. I'm a consultant for insurance, PR and communications firm Prince Communications, and we've got three engaging speakers with us today. Matt Coleman, who's the president of Reinsurance for Demex, a reinsurance MGA specializing in secondary perils, and Tom Mount and Emmanuel Modu, two of AM Best's most experienced experts. I'm going to formally introduce the presenters and then we'll get stuck into the agenda. So Matt Coleman has spent much of his career building risk transfer businesses within the reinsurance and weather derivatives markets and has been instrumental in helping develop the working layer aggregate severe convective storm reinsurance solution for Demex. Thomas Mount is a senior director at AM Best, and his responsibilities include recommending changes to the US and Canadian PC capital models, as well as global capital models. Tom also is responsible for analysing reserve deficiencies and assisting analysts with rating issues that impact best capital adequacy ratio. Emmanuel Modu is the managing director of Global Reinsurance and Insurance-Linked Securities Group at AM Best, where he's spearheaded the organisation's entry into index-linked structured finance transactions. His group's responsible for rating all insurance-linked securities related to catastrophe bonds, amongst many other things, including basis risk. Matt's going to kick us off with an overview of how the reinsurance renewal season went and what carriers have been doing with the much wanted savings that they've received.
Thanks so much, Nick. Pleasure to be here. I will share my screen and talk a little bit more about the overall reinsurance market, the secondary peril risk problem facing carriers, and also some solutions in the form of aggregate reinsurance that are helping to reopen this market. To start off, I wanted just to provide an overview of where we stand today in the reinsurance market. The market continues to be dynamic. We hear news reports, it seems, every day talking about the latest on reinsurance pricing and terms, and both pricing and terms continue to evolve. There is softening happening in the reinsurance market, but let's remember that this is coming off of a record hard market. And this is particularly true for low return period catastrophe protection. So kind of the traditional reinsurance protection we think of that covers against catastrophes is where we're seeing some declines off of these record high prices for this property catastrophe reinsurance. With that said, retentions of these programs remain very high and terms remain tight. And so one way to think about it is the belts of reinsurers continue to be notched quite tightly. And while there is competition to offer catastrophe protection, when it comes to lower return periods, higher frequency risks, there tends to still be a lack of appetite to cover those types of risks. And so in 2026, we've seen many primary carriers pocket some of these savings due to the lower prices on their catastrophe reinsurance. Yet these same carriers continue to hold excess frequency and secondary peril risk that is impacting not only their balance sheets, but day-to-day, quarter-to-quarter earnings. With that said, we do see some carriers are using these savings on their catastrophe reinsurance to pay for new aggregate reinsurance that addresses secondary perils. And we've seen some of these transactions incepting January 1st, all the way through to transactions we're reviewing that could incept later this year in June. So hopefully that gives you a good overview of kind of where we stand today.
Great, thanks, Matt. Because we've got people from a really sort of broad range joining the webinar today, we wanted to just set up a quick poll just to ask about your experience of severe convective storm risk transfer options. So pretty straightforward up there. Just like to know whether you have implemented them for your firm or from the broking side of things, whether you've implemented them for your clients. and you can choose all or none of them. That really depends on the structure of the program. So I'll just give you 30 seconds or so just to fill that in. So we can see, interestingly, that the use of ART and parametric and something cat bonds is really quite high amongst the audience, which is great. We ran a survey where we asked a question similar to this of the APCIA members last year, and the numbers were much lower in terms of people that had used the parametrics and ART. So hopefully this this discussion is going to be really useful for you in terms of how AM Best considers that. So Matt, I'm going to turn it back over to you to give everyone a little bit of an insight into the product that Demex has developed.
Great. So diving in, so who is Demex? We are a modeling and calculation agent that is helping to reopen the aggregate reinsurance market for frequency perils. We are a lean yet deep multidisciplinary team in terms of our expertise, with expertise ranging from the atmospheric and data sciences to technology, reinsurance, and capital markets. We are a venture-backed company that has been operating in the reinsurance market for over 3 years. And we truly take a functional and collaborative approach to serving the reinsurance market. Our product function has built a scalable AI and machine learning platform that models secondary peril losses. Our growth function partners closely with reinsurance brokers to distribute the reinsurance solution. And our risk function identifies reinsurers who are seeking diversifying and profitable underwriting opportunities. And so together, we're really excited about the success that we've had to address the growing problem and protection gap that continues to exist in the market. And that protection gap, it's quite stormy out there. And we see these headlines, it feels like almost daily now, talking about the large contribution of secondary perils to global insured losses, not only in the United States, but truly globally. We hear analysts and reports and lots of research around this notion of secondary in terms of these perils is not really relevant today when you add up all the losses that are coming from these non-peak perils. And this has ultimately led to the rising cost to reinsure these perils. And that's been most evident in the higher attachment points that reinsurers have been imposing on reinsurance programs because of the uncertainty around these losses and the difficulty in quantifying them. And what's been really fascinating about this is a few years ago, when these retentions went up by as much as 10 times on reinsurance programs, reinsurers effectively passed tens of billions to as much as 100 billion of frequency and secondary peril risk back across the table to primary carriers. And so conceptually, this can be evidence as kind of, pre-2023 and post the year 2023, where prior to that time period, there was a level of retained risk that was manageable for primary carriers. They set up their surplus, their earnings, and their overall business management to account for that risk that they're retaining. But due to these excess losses, particularly from these frequency and secondary perils, these retentions went up drastically, causing a lot of financial pain for primary carriers. And so what that has presented is an opportunity to better model and understand frequency losses from these perils, and an opportunity to create risk transfer products that can again address these risks and allow reinsurers to come back down the tower with confidence, offering this protection in aggregate form. And so the sun is peeking through the clouds. We're really happy and excited that we've joined hands with a number of partners in the market to grow the secondary peril reinsurance market and help close this protection gap. Demex is serving as an independent modeler that is using frequency data to produce and model frequency loss. We're looking at frequent weather data, exposure data, and actual loss experience data from a cedent to build them a customized model. And this reduces basis risk relative to industry catastrophe models that don't always have that cedent calibration. These cedent customized loss models have facilitated placement of over $300 million in reinsurance limit for frequent perils like severe convective storms and winter weather since we've been in market in 2024. And these are truly frequency covers. Attachments typically range from 1 in 3 to 1 in 5 year, covering these secondary perils on a ground up basis. And so not only the largest events are covered, but the small and medium sized events that together can add up to cause excess loss over a period of time are covered as well. And limits can be quite sizable, ranging from $10 million for smaller regional or mutual carriers operating in 1 or 2 states to more than 9 figures of limit for larger national carriers operating across wide swaths of the United States. And this highly rated protection serves as a full treaty coverage for the exposures of the carrier. And importantly, because this aggregate reinsurance is packaged in a parametric or a modeled loss form, it's cheaper by 1.5 to 3 times rate multiples. And so these indemnity aggregates, that have much higher loss cost uncertainty generally aren't being offered in the market. But by providing reinsurers what they really want, access to natural peril risk in a purely weather-driven modeled loss index, we've seen these prices come down significantly for this reinsurance. And ultimately, it's the end goal that cedents are receiving recoveries that ultimately help reduce their combined ratio volatility. And we've seen these recoveries in recent months really help provide an offset to those losses.
Thank you, Matt. It's really interesting. I must admit, I've always found it really quite impressive how close you managed to get the model DOS index to the actual indemnity losses because of the ground up claims data that you use and all the weather points. So I think that's great. And moving on, the question of how AM Best credits different reinsurance products is one that I hear a lot. So I'm really looking forward to Tom, followed by Manny, demystifying it all for us. So Tom, welcome your insight.
Thanks, Nick, and thank you everyone for attending today's webinar. Manny and I plan on tag teaming the AM Best portion of the presentation on how we treat reinsurance products in the rating process and in the capital model. First, I will talk about AM Best treatment of reinsurance, and then after that, Manny will jump in and talk about how we approach evaluating the basis risk of non-traditional reinsurance products. And then finally, I'll jump back on and talk about some of our views and potential approaches to how we will treat the Demex severe convective storm parametric reinsurance product. Okay, this slide shows AM Best's overall rating process. We call it the building block approach. It goes from left to right, starting with balance sheet strength, followed by operating performance, business profile, enterprise risk management, comprehensive adjustments, and then any rating lift drag for non-lead rating units. And then that will determine the final issuer credit rating. The capital model or BCAR model is in the balance sheet strength box. It gets the whole process rolling. It's the first component of the balance sheet strength. But we only use the first 4 VAR levels or confidence levels in the assessment of balance sheet strength. We use the most extreme VAR levels, the 99.8 VAR level, in the enterprise risk management evaluation to get an understanding of how companies manage and monitor the most extreme scenarios that could impact their company. This slide here is a little deeper dive into that balance sheet strength box. It shows all the components that we look at when we make an assessment of the balance sheet strength. And up on the top left, circled in red, we have our capital model, which is where we take a quantitative approach to looking at the balance sheet strength, and that's where we also take a deeper dive into some of the reinsurance. On the right, circled in blue, are some of the more qualitative things that we look at with respect to reinsurance. Who are you doing business with? How dependent are you on that reinsurance? Should pricing change or the reinsurance disappear? And then the appropriateness of the reinsurance program. Are you using quota share, XOL, things like that? And we'll get into more detail on that later in the presentation. But what you can see or take away from this slide is that reinsurance does factor in quite a bit into the rating process. The two types of reinsurance that we tend to look at is if we split it into both traditional and non-traditional reinsurance. The traditional reinsurance would include your proportional, which is your quota share or pro rata. Also your non-proportional, which is your XOL, excess of loss, on both a per occurrence and on a cat, aggregate cat basis. It's your treaty, your per risk, facultative, and usually one of the key features of the traditional is that it's on a prospective basis. The non-traditional can include cat bonds, both indemnity and non-indemnity, industry loss warranties, swaps, parametric reinsurance, and any kind of retroactive reinsurance, whether it's coded on a retroactive accounting basis or prospective accounting basis. And then finally, aggregate stop losses. And once again, even though those are usually prospective type of reinsurance, we treat them as non-traditional. Digging a little deeper now into the PC capital model or BCAR model. On the left, we have what makes up the available capital that the company has, and it starts with the reported surplus. And then we make some adjustments to get it to an economic basis. But then on the right side, you can see are all the components of the net required capital. There are 8 components, and 4 of them have impact from reinsurance. So the final score, the BCAR score is looking at how much excess or shortfall the capital you do have relative to the required capital. So reinsurance can have a big impact on the BCAR scores. So once again, taking a deeper dive now into those 4 components in the capital model, the B4 credit risk is the amount of recoverables the company has on its balance sheet. That'll include your ceded UPR, your ceded paid loss and LAE, and your ceded unpaid loss and LAE. B5, which is your loss and LAE reserve risk, the potential for adverse development. We want it net of prospective traditional reinsurance, and we can make adjustments for non-traditional or retroactive reinsurance. Similarly, on the premium risk page, which is the potential for underwriting loss on the upcoming year's business, we want that net of prospective traditional reinsurance also, and we can make adjustments for non-traditional retroactive reinsurance. And then finally, the B8 potential cat loss component. These are the PMLs, the probable maximum loss for nat cat or man-made cat. We want these net of prospective traditional reinsurance also, at least as, once again, as a starting point. And then we can make adjustments for the non-traditional retroactive reinsurance. Okay, this is just a screenshot from our supplemental rating questionnaire for the nat cat PMLs that we request. We request them on both a gross and net basis, but only net of traditional reinsurance. That's highlighted in the instructions may be a little difficult to read on this screen, but it clearly states that it should only be net of traditional reinsurance. In the BACAR model, we use the per occurrence PMLs. We do ask for aggregate PMLs also, and because they are used elsewhere, like in the basis risk criteria. So we do need to collect that information too. But for the capital model, we use a per occurrence net PML. So for the non-traditional reinsurance, then we do have a separate section in the SRQ where we try to capture the information on that non-traditional risk mitigation. That would include your cat bonds, indemnity and non-indemnity. The indemnity meaning that the actual reimbursements from the reinsurer are based on the actual losses incurred by the cedant. The non-indemnity means the reimbursements from the reinsurer are triggered based on something other than the cedant's actual losses. So that could be, parametric based, wind speeds, barometric central pressure, the magnitude of the earthquake, things like that. It could be an industry loss trigger. It could be a modeled loss trigger. And what happens is these other types of triggers create basis risk. And that's the risk that the cedant would incur a loss but not get full or any reimbursement from the reinsurer. And that's our concern. And that can also happen with industry loss warranties, swaps, and parametric reinsurance. So the next two slides just show some screenshots from our supplemental rating questionnaire where we ask for a deeper dive into each of the non-traditional reinsurance contracts that you're using to reduce your cat exposure. Some of the questions are like, what perils is it covering? What regions is it covering? What type of trigger does it have? What lines of business are covered? And then is it a single event, first event, second event, aggregate season, or something else? Some of the other questions, how much limit is left on the contract? It's potential. If some limit was used up already last year, we can't give full credit. We have to reduce it for the remaining limit. And then when does it expire? That's, this is an important feature because if it expires before, hurricane season, we would want to know that even if it's indemnity based, right? We would have to go to management and ask, do you plan on reissuing or replacing it with another cat bond such that if it wasn't being replaced, we can't give any credit for it, regardless of whether it was indemnity or not indemnity based. It just wouldn't be there when hurricane season comes around. But we also then do ask at the bottom, if we were to give credit for the non-traditional reinsurance, how much is your modeled credit at each of the VAR levels? And we would use that then to apply the basis risk scoring too. So if you're saying we think we should get $100 million of protection at the 1 in 250, we would want to know that, and then we would go and look at basis risk and score it for an appropriate amount of credit. This screenshot here just gives an example of a reinsurance tower where we have a mix of traditional reinsurance and some non-traditional reinsurance with two different cat bonds or one cat bond with two different tranches. We would want to evaluate how much credit we could give for those cat bonds because there may be some basis risk in those two contracts. So at this point, I'll turn it over to Manny, and he can talk about how we approach evaluating the basis risk in these non-traditional reinsurance products.
So we most often encounter basis risk in two segments of the ILS market, the cat bond market and industry loss warranties market. So in 2025, about $24 billion of cat bonds were originated. And $5 billion of those cat bonds had payouts linked to the PCS index, which is a property claim services index. Also in 2025, about $4 to $6 billion of industry loss warranties were originated, all with PCS triggers. Now, in total ILS capacity in 2025 was about $120 billion. So this means that about 8.3% of this capital had embedded basis risk in it. So we have a methodology, as I think Tom mentioned, to assess basis risk of ILS instruments, and it's called gauging the basis risk of catastrophe bonds. We can use this same framework to apply to parametric insurance or other non-indemnity products. Why don't you go ahead and advance? Great. So here are examples of non-indemnity cat bond issuers in 2025. There are 22 sponsors on this list, which includes global insurers, specialty insurers, and some unusual names like Los Angeles Department of Water and Power and Zencoren, which is a Japanese mutual reinsurer. The largest sponsor on this of non-indemnity cat bonds in 2025 was Everest Re, which issued about $1 billion worth of cat bonds through its Kilimanjaro program. So the cat bonds on this list will generally go through the same basis risk analysis I'll be walking through in this presentation. So this graph just represents basis risk. On the horizontal axis, you have model company loss. On the vertical axis, you have model index loss. Now we use the modeled company loss as a proxy for actual company loss. Now the points on the diagonal line means that index payout equals actual company loss. But the scatter is a reality because payouts follow an index, not the cedent's actual loss. So a point below the diagonal is a shortfall, which is when payout is less than the company's loss. And this is what AM Best is most concerned about. Points above the line are overpayments, but these don't offset shortfalls because a sponsor simply can't bank on overpayments. So this picture is exactly why we can't give 100% credit to non-indemnity insurance products. Next slide, please. So this slide shows a spectrum of basis risk, starting from lowest basis risk to no basis risk of indemnity insurance. The next category will be model loss, which may look like likely have which may look like your parametric insurance, perhaps. This basis risk is probably moderate, mainly because losses are calibrated to the cedent's historical losses, which softens basis risk. The next item is industry loss instruments like cat bonds that have a PCS trigger. These have moderate to high basis risk because regional weighting softens basis risk, but doesn't quite eliminate it. The instrument with the worst basis risk is ILWs, which basically is an instrument that is it's got an all or nothing trigger based on the PCS index. So there's no softening of basis risk at all here. So this slide shows basically the 6 factors we look at when we're evaluating basis risk. Each factor is scored from 1 being the best to 5 being the worst. So basically, we do a weighted sum of all the factors to get a single basis risk score. And the top 2 primary factors are shortfall and exhaustion probability. Collectively, these make up about 60% of the score. The next 4 factors collectively contribute 40% to the basis risk score. These include peril types, modeler involvement, and data quality, and business composition. Next slide. So let's talk about shortfall. So we measure a shortfall. We measure shortfall based on how much the index payout falls short of a company's loss. We use a 50% probability of a 50%. We use the probability of a 50% shortfall as our threshold. So if the probability of a 50% shortfall is less than 10%, the shortfall score is 1. If the probability of a 50% shortfall is greater than 25%, the shortfall score is 5. In terms of the exhaustion probability, we measure a chance that the full limit of the insurance instrument is used up in the in the company's business. This score scales by VAR level, so the same instrument scores differently at the 95% VAR level versus the 99.8% VAR level. Now, the other four factors have a weight of 10% each, but together they can move the total materially, of course. In terms of the peril type, we think the Florida wind scores the best. Cyber and non-traditional earthquake scores the worst. Severe convective storms sits just slightly better than cyber, although it too has less mature loss modeling, but it has reliable weather data. For independent modeler involvement, independent third-party validation earns the best score, and sponsor-only analysis is the worst. For data quality, real information about properties such as their precise location, construction type, roof type, occupancy, square footage, all these things matter greatly to us. Default value of these elements are red flag. For certainty of business composition, a company with a long, stable track record is the best. A shifting book of business is the worst. So this table shows the scoring-based reinsurance credit scale. So if the summed basis risk score is 1, the non-indemnity insurance gets 90% scoring-based credit. If it is a 5, the insurance gets 50% scoring-based credit. If the score is between 1 and 5, we do a linear interpolation. Now, overall, the scoring-based credit is capped at 90% because residual uncertainty always exists. Now, note that the same instrument can produce a different scoring-based credit at each VAR level. Next slide. So far, we've gone through the scoring-based reinsurance credit, but we're not quite done yet. We also have a second measure, which we call the capital effectiveness ratio, or CER. The CER, you can think of the CER as the amount of reinsurance credit a company wants to take, but scaled down by 10%. So if you look at the formula, the main components are PML before an instrument is added minus PML after it's added divided by the instrument limits. This is basically the credit the insurer wants to take, but we scale it down by about 10%. So the final reinsurance credit really is the minimum of the CER and the scoring-based credit. Whichever gives less credit wins. And I'm going to turn it back over to Tom.
Okay, thanks, Manny. Now what I want to do is explain how we would approach giving credit in the capital model for the Demex severe convective storm parametric reinsurance product. So this slide shows on the left what AM Best uses in terms of its PML for the catastrophe risk component of the required capital, and on the right, some of the characteristics of the Demex severe convective storm reinsurance product. So what AM Best wants to use is a per occurrence PML, and we would give credit for any indemnity-based reinsurance. Once again, assuming if the indemnity-based reinsurance is a cat bond, we would have to look at it, make sure it covers all regions and the peak perils, and it's not expiring. But assuming it meets all the criteria and it's indemnity, it would get full credit. It's all perils combined, and it's worldwide. So I have here all regions. It's really a worldwide PML. So what the Demex SCS product, and Nick and Matt, you can correct me if I misstate anything on this, but it's an aggregate season protection. So it's not per occurrence, it's aggregate season. It's parametric in terms of the trigger, not indemnity base. It covers severe convective storm only, which is fine if the primary peril that your company is facing is severe convective storm. But if it has other perils, there may be some issues in giving credit, or at least recognizing where we could give credit. And then it may only be regional. It may only be a few or single state, and it may not cover all states. So you can see there's a little bit of a mismatch in terms of what the model is requiring and what the product is protecting. So it's unlikely to get credit in the B8 potential cat loss component of the capital model. But where it is possible, or potentially we can give credit, is in the B6 premiums written risk component. And so why is that? So the premium page in the model, first of all, it represents the business the company's going to put on the books in the upcoming year. So it uses the current year's premium as a proxy for what they're going to write next year. And then the risk factors are capturing the volatility in the underwriting profit and loss. And that's driven primarily by loss and LAE ratio volatility over the course of the year, right? So it's a full year's premium. It's the volatility in that loss and LAE ratio over the year. So it's an aggregate impact, right? Or volatility. It's for the whole year. And the other thing is that when we created these risk factors for the premium page, we pulled out the large cat losses, right? So those peak perils are removed from the volatility because we're already capturing that in the B8 potential cat loss as a separate component. So we didn't want to double count. So what's left in there? Well, it's all your attritional and these more frequent smaller losses like you would get from a severe convective storm that didn't quite hit the peak peril XOL coverage, right? But you had a large number of smaller, more frequent smaller losses, right? That's in there, and that's what's creating this volatility that still exists, for the property lines. And the Demex product is attempting to protect that full year loss and LAE ratio volatility. So I think the credit is more appropriate here on the premium page. Of course, now the amount of credit that we could potentially give would also be a function of that basis risk evaluation. Because it is parametric reinsurance, there is the potential that there may be some losses incurred by the cedent that don't get reimbursed because of the weather triggers. And so we would look at that, and so maybe haircut the potential credit. We would also want to see, some historical analysis of, hey, what would the historical loss and LAE ratios look like if this Demex product was in place for these last 5 to 7 years? How much credit would it have given on a historical basis, just to get a feel for what the potential credit is. And then, we'd also, there is the possibility it could be limited by what we're actually seeing in terms of the volatility before we even get to the product. Some companies have some very high volatility because of the storm losses. Our capital model does have caps in terms of how far it will charge in terms of risk factors. We may have already felt that the cap loss or risk factors give enough credit already, and that maybe we don't want to also give even more credit. But that doesn't happen too frequently, but does happen. So we would want to look at that level of volatility before giving credit. So this last slide basically says, look, I may make a proposal for credit to the capital model. Manny may make a proposal how much credit to give based on the basis risk evaluation. But the rating committee will have the final determination as to how much they want to give in terms of the quantitative credit and also in the qualitative credit. But really the main point on the qualitative credit is that, where I see this being most important is the appropriateness of the reinsurance program. If you were to institute a parametric reinsurance program to supplement the traditional peak peril type of reinsurance, and it fills in some of the gaps and mitigates some of that leftover residual volatility to the annual combined ratio or loss and LAE ratio, that would likely be viewed positively. However, if a parametric program that has basis risk as your primary protection would likely be viewed negatively. That's all I have in terms of the AM Best's view in terms of the rating process and the product, and I'll turn it back over to Nick and Matt.
Great, thanks very much, Manny and Tom. That really helps my understanding, and I am sure all of the attendees out there as well. We do have a couple of questions. What steps do I need to take as a carrier to provide AM Best with the kind of correct data in the right format to achieve the maximum credit for my modeled loss SCS reinsurance product?
Yeah, it's hard to say that there's a specific format because each model produces data in a different type of output. But I think if we look at the ILS criteria, the gauging basis risk of cat bonds, that will give you an idea of what kind of data we need or what kind of output we need, specifically for all those scoring components, and then the calculation for the CER, the elimination ratio. So starting with the shortfall probabilities, right? We would want to know, what's the probability of the 50% shortfall. So if you look at the table in the basis risk criteria, you can get an idea of what we're looking for there. How often does the modeled loss the reimbursement fall short of the actual loss? The attachment and exhaustion probabilities, what VAR level does the coverage attach and when does it exhaust? That's also an important piece that we would need to know. In terms of the modeling, the independent modeling, who's doing what portion of the modeling? Is Demex doing the modeled loss using the AIR model, or is AIR, doing that portion of the modeling, and Demex is only doing the parametric reinsurance modeling? They're doing the calculation. Who does what in the modeling process? That's important. And then data quality metrics. Does the data have all the secondary, primary and secondary characteristics coded? The less of that's coded, the less confidence we have in the modeling. Is the data, are the locations geocoded to street address? That's important too. If only 50% are geocoded to street address, that would reduce the amount of credit available. So we would need to know those data quality metrics. Business composition. Obviously, if you have a stable book of business that doesn't turn over or change much from year to year, that's great. That gives more predictive confidence and give more credit in the scoring. If the book turns over quite a bit from year to year, or moving into new states, from year to year, that turnover creates less confidence and a lower score. And then finally, as I mentioned earlier, the aggregate season PMLs, we use that in terms of coming up with the quantitative credit scoring piece of our formula, where we take in the minimum of the qualitative scoring and the quantitative scoring, this aggregate season PMLs, with and without the severe convective storm reinsurance, would give us an idea of how much credit the company has modeled, and then we would apply 90% to that. So all of those components would be needed in order to give some credit, or possibly give some credit for the reinsurance product.
Great. Thanks, Tom.
I was going to say, we'd also, like to have a copy of the reinsurance agreement itself, who the reinsurers are, and then, what's the cost of the reinsurance, as well as those 5 years of what if historical loss ratios. What if they had this reinsurance product in place over that time period? How much credit or how much reduction in the loss and LAE ratio would they have experienced. So that's pretty much it. I mean, that's a lot. That's a lot to provide, but it's the basis risk is a big concern of ours, and we want to make sure that we evaluate that properly.
No, that makes a lot of sense. Thanks, Tom. I've got a quick follow-up question. Would you kind of look at things slightly differently if let's take the model loss SCS reinsurance product, if carriers had bought that for a year or had bought it over let's say a multi-year period?
Yeah, I mean, that's a great question. I mean, surely the more actual experience, the better, right? Although, doing a what if for those missing 4 years is helpful. But yeah, I mean, if they've been purchasing the product for a number of years already, then we have some actual history that we can work with, as well as the predictive piece, and the model pieces. We can see whether what's actually happened to what was modeled to happen. But certainly have actual experience is great, especially if there have been a lot of losses, right? You can say, hey, look, it worked, as we planned it. Actual history is great in giving us confidence in the reinsurance product.
Awesome. Thank you very much.
Yep.
Cool. Matt, one for you. What kind of cross-validation does Demex use to make sure that the modeled loss index is as accurate as possible?
Yeah, this is a key question that we receive because any modeler can take any input data and produce a model that replicates that input data. And so when we're spending time with cedents, with brokers, or with reinsurers, we spend a lot of time talking about the different statistical tests that we do to validate the model. One of the key tests, as an example, is a data withholding test. And so if we are studying the loss of, say, the year 2023, and we withhold training data from 2023, but use all the other years that we have available to predict 2023, can we still predict the actual value that occurred? And the good news is, yes, we almost always see a very tight grouping of our modeled loss prediction that uses all training data, but also our modeled loss results that use only a fraction of the training data. And so that's a very important step because that gives both sides of the transaction, some indication as to how the model will perform in the upcoming year. And so without the training data to build the model, can the model still predict losses that happen in that historical year and adjusted for the upcoming year? And the answer is yes. So that's a really important step in our modeling process and also helping with basis risk assessment.
Great. Thanks, Matt. Manny, this one's probably for you, although it may be a Tom one, but what's sort of the biggest challenge that you face with giving credit for aggregate stop loss products?
I imagine it will probably be the modeling. I mean, we have to, obviously, Demex in this case, we have to be involved in the modeling of the products in terms of giving us things like the shortfalls, for example, right? Probably every shortfall. That is something we have to get. Sometimes people just, we just use default values for those. And of course, it's quite punitive. So I would think that your involvement would be quite critical, right, in providing that data, that information. And also, I think ultimately the issue related to data quality is really quite important too, because we find that at least when we look at models related to like AIR and RMS, quite often companies will just use default values in the modeling process. So it's quite important to know exactly the type of properties that's involved in the coverage that for which you're providing this type of insurance. So data quality, of course, and shortfalls are quite important.
Right. Thank you, Tom. I felt like you were speaking, so yeah, carry on.
Yeah, I was going to say, from my point of view, a lot of times one of the main issues is the ELR, the expected loss ratio. sometimes the company and AM Best have very different views of what the expected loss ratio is for the upcoming years. We'll look at Schedule P and see that the historical loss ratio for the last 3 years may be 80%, and yet the company's using an expected loss ratio for the upcoming year of 60%. And then structure, where the protection comes in, and if it comes in from 60 to 80, we may not give credit because our view for the upcoming years, that's in the working layer, it's below the expected loss ratio, whereas the company thinks they're getting protection in the risk layer, which is above the 60. So there could be some issues with expectations going forward. As I mentioned earlier, the volatility of those loss ratios too could be an issue. And then finally, what's the company's long-term commitment to this? Do they plan on renewing it every year going forward, or is this just an opportunistic 1-year type of protection? And so once again, we want to see our credit ratings are for the long-term protection of policyholders. So we want to see that commitment for the long term.
Great, thank you. I've got another audience question. We might well still have time for one or two if people do have more questions. It's a really specific one for you. So in the SRQ PML section, you specifically say to exclude the benefits from cat bonds, ILW, and other non-traditional risk mitigation. So my net PML is not being reduced for these. How can my net PML be reduced in BCAR if you're excluding it?
Right. So the starting point, the net PML is not reduced for the non-traditional. We will then look at those other pages in the SRQ that give us more detailed information about the non-traditional reinsurance program, and then we'll make an assessment, whether we have to do the basis risk analysis, and then we'll say, okay, we went through the analysis and the scoring, and we're only going to give 75% credit to the reinsurance protection. We'll reduce then that net PML by the 75% of the potential credit for the non-traditional product. So that would be a manual adjustment that the analyst would have to make, but after reviewing this non-traditional reinsurance product. And that would be the cat bonds, the ILWs, and things like that. And this particular SCS Demex product, we would have to make manual adjustments to the premium page instead.
Thank you. Thanks very much. Now, I don't have any more questions. Looks like I don't have any more questions in the Q&A. So I'd really like to say thank you to everyone who has attended. We'll be sharing a copy of the webinar. If you do have any further questions, then you are most welcome to send us an email directly. I've put the addresses up on the screen, either to Demex or AM Best. And finally, I really want to thank Matt, Tom, and Manny for their great insights into this detailed topic. And enjoy the rest of your day. Thank you very much.
Thank you.
Thank you.
Okay.